Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to give you a preview of what I expect May's inflation numbers are going to be based off the final demand model, and as well as a back of the hand writing on the napkin calculation that seems to confirm this, and also give you an outward projection of where I expect inflation to go for the year's end. So last month, my final demand number was off on projecting the monthly CPI. It predicted that the CPI would jump by 1.3%. That's because we had been seeing this high monthly jumps in final demand. And in reality, the CPI jumped by 0.3%. A lot of that was caused by falling energy prices. But even then, it would have ended up on the low end of the model increase. And so now what the model is showing is that we should see a monthly change in the CPI of 1.1%. But how do we know that that's actually going to be accurate? How do we know that this is reliable, besides the fact that this model tends to be accurate 95% of the time? So pushing aside the statistics of this, let's try to see what we can do to verify this 1.1% projection. When we take a look at the historical trend of the CPI, and then factor in an energy calculation based off of the fuel prices pulled from EIA.gov and how that affects the energy component of the CPI, we can accurately project outward what the CPI will be for the given month based off the historical trend of core CPI and the food element of CPI. So once we take these three components together, you can see here that the projection has been fairly accurate in predicting the CPI. It even went as far as to predict that April CPI would only increase by 0.4%, and in the actual increase was 0.3%. So very, very close, and it would have captured what my final demand model would have missed, and that is because it's taken into account real collected fuel prices to project outward that energy component of the CPI. Basically, what it's showing is that the energy component of the CPI will jump by a whopping 0.5% as a component of the CPI. So the energy prices are going to jump much higher than that. It's actually going to jump by about 6% or so. But as the component of the CPI, the CPI will already push up by 0.5% just from these energy prices. And then when we factor in the historical fuel or the historical food increases and the core CPI increases, we're looking at a 1% increase for May. So it is all but certain that this final demand calculation estimate is going to be accurate. And I think that that's going to burst a lot of investors' bubbles and expectations about falling inflation, because it's going to force that annual rate back up. And if it hits that 1.1%, then it's going to retest that high, that previous peak that we saw in the last couple of months. And unfortunately, if it goes higher than that, then it will create a new high for the CPI, and that can create a lot of panic among Wall Street as there will be higher yields, higher interest rates on bonds. It will force the Fed to tighten their stances even more so than what they expect, and it will all but destroy the narrative that inflation is calming down and what we've seen is the worst of it. And although I am telling you that eventually, based off of what we're seeing in the money supply numbers on my last video, that eventually we will see peak inflation, I don't think that's hit yet. One of the things I've done recently is recalculate my price formulation index. So I've created a couple of indices to sort of estimate where the CPI is. One of them is my business expense index, which is an average of the median wage and the producer price index for all commodities. That's a very easy way to gauge where the CPI is, but it's not a very easy way to predict or project out where the CPI will head. On the other hand, my price formulation index, which is composed of money, growth, GDP, and now a new element that I've added into this, the total debt in the economy. Once you average those two components together, it really does have a strong correlation with the CPI ever since the late 1960s, early 1970s when the U.S. came off the gold standard. And so right now what it's saying is that the CPI is understating where the price formulation index is by about 10%. Now, it has been this in times past. We have seen the price formulation index run hotter than the CPI by about 10%. And instead of having a rising just jump in the CPI increases, we saw a stagnating producer price price formulation index until the two lines merged. So it doesn't necessarily mean we're going to see a pickup in price inflation, but it definitely corroborates the narrative that we should be seeing further increases in price inflation, even at the high rates that they are, until we see a reconvergence of this line. So projecting out to 2022, if we see the CPI jump up to 10.5%, which I think is pretty reasonable to show that the gap is being closed there, then by all means, it will pretty much bring it in line with that price formulation index. And that's factoring in the fact that money growth has been pretty stagnant year-to-date 2022. So this sort of reinforces my narrative here that price inflation hasn't peaked yet. I think we're going to see it push up over 10%. And if I was going to project this out, it looks like we're not going to see that peak price inflation of over 10%, possibly even peak 1 month at 11% year over year until sometime at the end of 2022 or even early 2023. Now, there's other factors that can affect this. One thing is that the CPI might peak at 8.5 and just stay that high for the rest of the year while the price formulation index stagnates. And then we see a convergence of the two lines in 2023 sometime. So there's not guaranteed that it means that price inflation will push up. Nevertheless, looking at May's numbers, that's going to show another 1 month jump, and the final demand model pointing to that we're going to see a retesting of the previous peaks, and the fact that fuel prices and commodity prices are still showing a higher growth momentum. The narrative is there on my side. I believe the weight of evidence is on my side statistically that we just haven't seen the end of price inflation yet. This is not the peak yet. The peak is yet to come. And, even though the money supply numbers have flatlined, we're still seeing a lot of debt growth go in. We're still seeing a lot of geopolitical factors weigh in on commodity prices. So that tells me that we've still got room to go on the CPI front. Guys, as always, I thank you for watching this video. When the inflation numbers do come out in the next week or two, I'll give you an update and then compare to my projected numbers on this final demand model, as well as this back of the hand calculation that I did, and let you know just how accurate it is. And again, once those final demand numbers come out for May, we'll project outward for the next month. But more than likely, what we should is a confirmation of this increase in the CPI by, basically caused by the levels of money that was pumped into the economy from 2020 to 2021. And so if that's the case, we should see that CPI still push up forward. Once again, guys, I thank you for watching this video. If you like the content, make sure you click the like button, comment down below, let me know what you think about all of this, subscribe to my channel if you haven't already, and as always, click that notification bell. I'll talk to you next time.